Traders who deal with large amounts of capital in the stock market often use strategies and techniques that allow them to manage and invest significant sums effectively. Here are several ways these traders, such as institutional investors, hedge funds, or high net worth individuals, typically operate. 1. Institutional trading, large volume trades, block trades. These are large trades, usually involving thousands or millions of shares, that are typically executed outside the open market to avoid impacting the stock price too much. Institutions may use brokers or electronic systems to execute these trades without disrupting the market. Algorithmic trading. Algorithms are designed to break large orders into smaller ones and execute them over time to minimize market impact. This helps avoid large price swings that could occur if all shares were sold or bought in a single transaction. Dark pools. These are private exchanges where large transactions can be executed without revealing the details of the trade to the public market, helping large traders avoid slippage, unwanted price changes due to market visibility. 2. Leverage. Many large traders use margin accounts or leverage to control larger positions with a smaller amount of capital. This means they borrow funds from a broker or financial institution to increase their buying power. While leverage can amplify returns, it also increases the risk of greater losses. 3. Diversification. To manage risk while trading large amounts of capital, big traders typically diversify their investments across various asset classes, sectors, and geographic regions. Diversification reduces the risk associated with any single stock or asset class. 4. Long-term investing. Large traders often focus on long-term growth rather than short-term trading. They may take significant positions in large-cap stocks or established businesses and hold them for extended periods, benefiting from capital appreciation, dividends, and overall market growth. 5. Hedge funds and private equity. Hedge funds. These funds pool capital from multiple investors and use it to take large, concentrated positions in stocks, bonds, or derivatives. Hedge funds often employ strategies such as short selling, derivatives trading, and leverage to maximize returns. Private equity. These firms invest large sums of money into private companies, or take public companies private, to restructure, improve, and grow the businesses before eventually selling them for a profit. 6. Venture capital and IPOs. Venture capital, VC. Traders or firms with substantial funds may invest in startups or early-stage companies. These investments often come with higher risk, but the potential for significant returns if the company succeeds. Initial public offerings, IPOs. Large traders often participate in IPOs to buy shares of a company when it goes public. This allows them to buy large quantities at the offering price before the stock hits the public market. 7. Options and futures contracts. Large traders also use options and futures contracts to control larger amounts of underlying assets. This allows them to gain exposure to significant market movements without having to purchase the underlying stock outright, which can be capital intensive. For example, a trader might use futures contracts to buy or sell a large quantity of stock indexes, allowing them to manage large positions without having to buy or sell the physical stocks. 8. Professional research and networks. Traders with significant capital often rely on extensive research teams, financial analysts, and trading algorithms to help them make informed decisions. They might also have access to private networks and institutional data that individual retail traders typically do not. 9. Private placements and direct deals. Large traders sometimes get involved in private placements, where companies offer securities directly to investors without going through public markets. These investments may require a significant amount of capital, but can offer more favorable terms, such as discounted prices or preferred shares. 10. Market makers. Market makers are firms or individuals who provide liquidity in the market by buying and selling large quantities of stock. They often facilitate large trades for institutional investors and can profit from the spread, the difference between the buy and sell price. Summary: large traders typically have access to specialized tools, information, and resources that allow them to manage big sums of money. They employ strategies like algorithmic trading, diversification, using leverage, and participating in private deals to execute large trades without causing major market disruptions. These methods help them trade in larger quantities efficiently while managing risk and maximizing returns.